Hello everyone, today we're going to summarize The Little Book of Common Sense Investing by John C. Bogle. Do you ever feel overwhelmed by the different mutual funds out there? It's like trying to pick your favorite chocolate bar from a whole candy store. So, how do you choose where to invest your hard-earned cash? Well, one option is to go for security. You can join a low-risk fund that spreads your money out across lots of different investments, so you're not too affected by ups and downs in the market. Or, if you feel bold, you could join a high-risk fund that might bring bigger rewards. But with so many options, it's easy to get confused and end up making decisions you regret. That's where index funds come in. Think of them as your trusty sidekick in the world of mutual funds. They're like the chocolate bar that never lets you down. In this video, we'll break it all down for you. You'll learn about the difference between passive and active funds, why it's crucial to pick the funds with the lowest fees, and how to steer clear from market bubbles. So sit back, relax, and let's dive into the world of mutual funds. The first takeaway from this book is actively managed funds can be pricey and often fall short of market performance. Have you ever invested in the stock market? If so, you might have realized that evaluating the attractiveness of a stock is tricky business. That is why many opt for actively managed funds instead of directly investing in stocks. In these funds, money from multiple investors is pulled and entrusted to a specialized fund manager. This manager regularly adjusts the stock portfolio based on the current market conditions. However, this approach carries significant risk due to the high cost involved. Investors foot the bill for brokerage commissions, fund manager fees, and other expenses, eating into potential profits. While stellar performance might offset these costs temporarily, over time, actively managed funds tend to yield lower profits compared to the broader stock market. So why does this happen? And the reason is because speculating on stock prices is not a sustainable strategy. While it may seem lucrative to buy undervalued stocks and sell them when they rise to their true value, this tactic can't consistently outperform the overall market growth. Coupled with the hefty fees, this means actively managed funds often generate substantially less profit than passive low-cost index funds, which simply track the market performance. In fact, the disparity is striking. If you had invested $10,000 in 1980, by 2005, you had walked away with 70% less had you chosen an actively fund over an index fund purely due to fees. The second takeaway from this book is few funds perform well, and there's no guarantee even those few will continue to do so. Despite grasping the steep cost associated with funds, you might still contemplate investing in actively managed ones. But before you do so, pause to assess their performance against the broader stock market. Unfortunately, the majority of these funds fall short or fail altogether in delivering substantial returns, despite investors paying out these high fees in return of the market acumen of these financial experts. Only 24 out of 355 mutual funds that existed in 1970 have outperformed the market and stayed afloat. Knowing these statistics, it becomes apparent that entrusting your money to financial experts might not yield the desired results. Furthermore, even profitable funds can't promise good performance in the future. While you might be tempted to invest in the rare few that have defied the odds, it's crucial to acknowledge that past performance doesn't guarantee future gains. Consider this: if a fund has consistently outperformed the market over the last 3 decades, it's likely due to the expertise of its manager. But managers inevitably retire, leaving uncertainty about the successor's ability to replicate their success. Furthermore, the investment landscape of the future will differ from the past. What worked in the last 35 years may not hold true to the coming decades. Anticipating future investment opportunities is a gamble, one that lacks any certainty. The third takeaway from this book is many individuals invest in actively managed funds without fully grasping the consequences. After shedding light on the underwhelming performance of most funds, you might question why people persist in investing in them. Firstly, investors often underestimate the genuine expenses associated with actively managed funds. Despite the high cost inherently tied to these funds, Fund managers seldom disclose the actual dollar amounts. Instead, they tout impressive returns while conversely overlooking the deductions from performance and portfolio fees. Shockingly, this oversight is commonplace. 198 out of the top 200 performing funds in the late 1990s reported returns higher than what investors actually earned. Secondly, emotional impulses and prevailing market trends frequently cloud people's investment decisions across different avenues. All too often, people make unsound investment because they let popular opinion and clever marketing sway their decisions. For example, recall the high-risk investments in the late 1990s. In contrast to the first half of the decade, when people invested a mere $18 billion in the stock market, a whopping $420 billion was invested in the second half of the 1990s, when the market thrived and stocks were overvalued. When the bubble eventually burst, people realized too late that they had given into the popular hype. These behavioral patterns extend to actively managed funds as well. Investors flock to them because everyone else is doing so. So, if you shouldn't allocate your money to actively managed funds, where should you put it? Well, in the next takeaway, I will show you where. The fourth takeaway from this book is the safe investment, low-cost index funds. Don't let what you know about actively managed funds persuade you to keep your money under your bed. The index fund is the best alternative. In contrast to actively managed funds, index funds are much more cost efficient. By definition, an index fund holds a diversified portfolio that reflects the financial market or a specific sector. However, instead of betting on the market, index funds hold their portfolios indefinitely, eliminating the risk of making short-term, volatile bets while simultaneously minimizing operating costs. Because index funds track the performance of all stocks included in the index without betting on individual stocks, they're also called passive funds. Since they hold shares across particular market sectors, you will not have to bear operating fees for buying and selling shares, financial consultants, or fund managers. You will, however, reap the benefits of commercial net returns. Another advantage to index funds is that they are likely to outperform actively managed funds in the long term. You might argue that holding shares indefinitely instead of buying when stocks are cheap and selling them when they're expensive results in lost opportunities. However, you already learned that in the long term, the rises and falls of the stock market eventually level out at the real value of the stock. Because of that net effect, index funds usually outperform actively managed funds in the long run. They offer returns at the real value of the stocks while eliminating actively managed costs. In the next part of this summary, we'll help you choose the right index fund. The fifth takeaway from this book is choose the cheapest index fund. Each index fund comes with an expense ratio that represents management fees and operating expenses. These expenses, though they're typically less than 1%, can add up in a long-term investment. For example, Fidelity Spartan Index Fund has an annual expense ratio of 0.007%, while the JP Morgan Index Fund is 0.53%. Both funds have expense ratios below 1%, but over a long-term investment period, like a decade for example, those tenths of a penny add up. Since index funds fluctuations follow the overall market, go ahead and choose the fund with the lowest cost structure, knowing firsthand that a company expense ratio doesn't equate with its level of performance. The last takeaway from this book is be wary of new investing trends. Whenever you are considering where to invest your hard-earned money, be skeptical when it comes to the latest investment fads. The fierce competition between index funds caused a continuous cycle of new trends. Index funds were invented in 1975, and today there are already 578 index funds competing with each other. Long-standing funds compete by trying to lower their costs as much as possible and thus lure in discerning investors. Meanwhile, new funds entering the market attempt to gain clients by promising large rewards through new stock picking procedures. Consequently, they also charge more. For example, the new Copernicans abstained from compiling their portfolios with stocks chosen by customary method, like weighted market capitalization, whereby stocks are bought in proportion to the total market capitalization of each company, meaning the total number of shares multiplied by the average share price. Instead, the movement might calculate the proportion of each stock in their portfolio based on, for example, how much profit each company earns, or how much they paid out in dividends. Remember though, no matter how funds claim to operate, it's nearly impossible to know which stocks are over or undervalued, so you shouldn't adhere to funds that retain a normal portfolio. Furthermore, since you can't predict which new investment trends will be successful, you should remain cautious and keep low costs the priority. And this was the summary of the little book of Common Sense Investing by John C. Bogle. If you like this video, please give us a thumbs up. And if you're new here, please consider subscribing. Thank you very much for watching.